Good evening, everyone. So this is our beginners class, and on this class, we're going to be discussing the origin of Forex, the basics of Forex, right? What is Forex trading? What is Forex trading? And in discussing the origin of Forex trading and what is Forex trading, we are going to attempt to look at it not just from the perspective of Forex alone, but from the perspective of the global financial markets, right? Because the global financial market is much bigger than just Forex alone. The global financial market is way bigger than Forex. There are other markets within the global financial market of Forex market itself is just a part of the entire global market. Right? So we're going to be introducing you to the global financial market, and with that, we'll be able to completely wholly understand, the entire market, the global financial market, and then Forex, than the Forex market in particular. So trading started a long time back to the barter system. So I'm sure some of us understand the barter system where you needed to exchange one thing for another. So you had rice, I had tomato. Needed rice, I needed tomato. So we exchanged that. That was the barter system. Now, in every generation, value is always what is exchangeable. Whenever we want to exchange something, it's always value. We're always exchanging value. You have something I don't have something you don't have, we exchange that. That is a trade, right? Trade is basically exchange of value. Now, later on, when this concept of money was introduced, then we started talking about buying and selling. During the barter system, there was no buying, there was only exchange. Yet value kept changing hands, right? This is the origin of trade, but it was trade, but not in the sense that we know it today. Now, trading is the buying and selling. Now, what today? Trading is now the buying and selling of global market, of the global selling in the global financial market, right? And in this case, what we're doing is we're speculating mostly on price movements. Okay, so we pick an asset. Let's say we pick an asset, whatever asset it is, and then we are trying to speculate on the price. Is the price going to appreciate? Is the price going to come down? That's what we are basically trying to. That's what we are basically trying to speculate about. So in this class, we're going to be focusing more on e-trading, electronic trading. Okay? And the trading in the financial market is basically electronic trading. It's not the physical exchange of goods and services. It's not the physical exchange of currencies. It's not a physical exchange of commodities. It's an electronic transaction, electronic trade, where it is settled instantly and your profits are settled into your account instantly, right? So e-trading is all about buying and selling financial instruments and financial assets. Okay, and here we are dealing with this within the context of the global financial market, right? Now, let's look at this. The global financial market itself is a worldwide online marketplace. The global financial market itself is a worldwide online marketplace where buyers and sellers, watch this, where buyers and sellers trade financial assets or financial instruments. Okay, now take note of the words here. We say the market is a worldwide market. Worldwide meaning that it's happening at the same time across the world. Online meaning that it is delivered through your internet-enabled device. You don't need to be in a physical place or a physical location in order to be able to participate in this market. No, all you need is a device that can connect to the internet. Once you have a device that can connect to the internet, you're already in the financial market. You have what it takes to play in the financial market, right? That's what it is. And when we talk about financial assets and financial instruments, what are we talking about here? That's the next thing we're going to talk about. What is this global financial market? What does it entail? What do we buy and sell within the global financial market? When you are trading in, when you go to a physical market, for example, where vegetables are sold, what you expect to be able to buy in such a market is vegetables, buy or sell. There are those who come there to sell. There are those who come there to buy, right? There are those who come there to buy. There are those who come there to sell. Now, when you get into that market, you decide whatever you want to do, you be it buy or sell. But basically, you are not expecting to be able to trade any other commodity other than what is being bought and sold in that market. So in the global financial market, what exactly are we buying and selling? What exactly are we buying and selling? That's what we're going to be discussing next. And yes, here are the categories of assets and instruments that we're buying and selling in the global financial market. The first one is what we call currencies. And this is what we refer mostly to as Forex. Forex is foreign exchange. When you are exchanging one currency against another, that is what we call foreign exchange. Okay? So when you buy and sell currencies, that is what we refer to as Forex. Okay? The market is so big, it's actually the largest part of the global financial market. So it's something that dominates mostly. It dominates more than the rest of the financial market. You hear more about Forex because it's actually the larger part. It's the larger part of the global financial market. Okay, so currencies is number one. When you trade the euro against the dollar, the pound against the US dollar, and so on and so forth, that is what we call currency trading. But the reason we say the financial market is bigger than just Forex, you will be able to see that we're not just trading Forex, we're trading other things. The second category here is commodities. And the two most popular commodities are gold and oil, gold and crude oil. Now, there are several other commodities as well. There are commodities like palladium, platinum, even agricultural produce and all of that. We're going to discuss a bit of them as we progress. Now, those are commodities, and those are also being traded in the financial market as well. Okay, then the third category is what we call indices. Indices are a basket that contains stocks. A basket that contains stocks. And what are stocks? Stocks are fractional ownership of a company, pieces of a major company, fractions of the ownership, fractional ownership of a very big company. Let's take a company like NVIDIA, for example. NVIDIA would like to sell shares or sell stock to the public to raise funds. Recently, we see that Figma did its IPO and then sold its stocks to the world, sold its stocks to the market, to the public market, right? And that is what companies do. They come and they sell their stock to the open market, and people come there and buy. They invest $1,000, they invest $5,000 or $10,000 or even $500, and they're able to become part owners in that company. They are able to own stock in that company, which means that if that company is making profit and getting bigger tomorrow, they are able to participate in the upside that comes with that investment, right? They're able to participate in the upside from that investment. That's a stock. So most companies, the largest companies in the world, have their stocks publicly listed or publicly traded, which means that if you want to own a piece of Tesla, you can, no matter where you are in the world. These days, if you want to own a piece of Microsoft, you can. If you want to own a piece of NVIDIA, you can. Okay, those are stocks. And what happens is that companies use issuing stocks to raise funds for the purpose of expanding business, while individuals like you and I who go to buy those stocks actually do it as a form of investment. And the goal is to be able to get a higher return, better returns tomorrow on the money that we invested. So if I invested $1,000, I'm hoping to make way more than that. I'm hoping to make way more than that in the course of a year, or 2 years, or 5 years, or 10 years, right? That's what I'm looking to do. Okay, that's basically what I'm looking to do. That's what those stocks are. Indices are like a basket, like I said before, a basket of stocks, different stocks, right, that are held within that basket. So think about, picture this: you go to a mall and you want to buy fruits. You take that basket and you're shopping for different fruits. You put grapes in there. You have oranges, you have pineapples, you have apples, and so on and so forth. Those fruits you are adding to that basket are the individual stocks. But the basket itself that's carrying everything is what we call an index or indices for several. So you call that indices or index for one. Per one, we call it index. For more than one, we call it indices, just singular and plural, right? Now, when it comes to NAS 100, you see that NAS 100 is the 100 there is telling you the number of individual stocks that are located, that are contained within the NAS 100. The NAS 100 has 100 individual stocks within it, right? So NAS 100 is sometimes known as the US 100. Now, the second one here is US 30. US there is telling you and I that that index is a US denominated, is US denominated index. It's a US located index. That's the meaning of the US there. The 30 is telling you about the number of stocks that are contained within that basket called US 30, right? So when you see DAX 40, DAX is telling you that this index is from Germany. It's a German-made index. The 40 represents the number of individual stocks that are contained within it. So sometimes DAX 40 can be known as DE 40, right? So yeah, or GER 40. Okay, that's the way it is on Vantage. Then you have SPX. SPX 500 is what we call the S&P index. So the S&P index is the largest index in the world. It contains over 500 individual stocks. Over 500 individual stocks. So the S&P index is the basket that holds over 500 individual stocks within it. And this is one reason why indices are very volatile, because they hold a whole lot of individual assets, and they are now being held like an aggregate. They are now being aggregated within that index or indices. Okay, these are different categories of instruments or assets that are being traded in the market. So you see, the global financial market is much bigger than just currencies alone. Currency is what we refer to as Forex. Then another category here is what we call cryptocurrencies. And this has become very popular very recently. The first cryptocurrency was issued in 2009 by a man called Satoshi Nakamoto. Right? He wrote a white paper and he talked about this decentralized currency. And then he created the first Bitcoin, and then he capped it at 21 million and said it will never be more than that. From then on, a whole lot of other cryptocurrencies have sprung up in the course of several years. So we see Ethereum is there now. We have Ripple. We have even what we call stable coins. All of them stem from this technology, this cryptocurrency technology called blockchain. So these are assets that are tradable in the market. You can trade them. And like we said before, what we are doing here is we are not holding the underlying asset. For example, if I go and trade in oil or I'm trading gold, I'm not buying physical oil to keep. I'm not buying gold bullion to keep. I'm speculating on the price of gold. So if gold moves from 3,000 to 3,200, and I'm able to speculate that, I'm able to predict or speculate on that, all I need to do is that I would have made a buy at 3,000, and then by the time it's 3,200, I've exited and I made a lot of money. You see? So that's the move. That is what we are doing here as traders. We speculate on price movement. We don't buy physical gold to keep. Most of the time, it's central banks that do that. Of course, there are also very high net worth individuals who want to put their assets into physical gold. But mostly we don't deal with physical gold or physical assets. In the market here, we are basically speculating on their price. Then we have ETFs. ETFs are called exchange traded funds. They're specialized kind of investments that are for ultra wealthy people, right? And they're usually created by very huge funds, like the Black Rocks of the world, like the Fidelities of the world, like the Blackstones of the world. Those huge mega investment companies in the US, they are the ones, and in several places, they are the ones that create ETFs. ETFs are usually assets or investments that mirror a certain asset, a certain underlying asset. So we can have what we call a Bitcoin ETF. So that Bitcoin ETF is listed on the stock exchange, on a regulated exchange, and then there's a lot of protection whenever an asset is operating within a regulated environment. There's usually protection. Someone cannot come as easily swindle people who are playing within a regulated environment. So you will see that a Bitcoin ETF will be an investment that mirrors the price of Bitcoin in real life, yet it is not Bitcoin, yet it is even more secure than Bitcoin itself. You cannot, when an investor buys an ETF, that is safer than buying the underlying asset. So investors who have a lot of money they feel better when they buy ETFs to an asset rather than buying the asset itself. So there are gold ETFs, there are silver ETFs, there are Bitcoin ETFs, right? So investors prefer to buy these ETFs rather than buy the underlying asset, which can be stolen, which can be taken, which can be, damaged. But the ETF itself is located, is a digital investment, and it can be destroyed just like that. So in order for you to trade successfully in this market, we want to understand three things. Number one, what is it that is traded in this market? What is it that's traded in this market? Number two, who else is trading in this market? Who else is it that's trading in this market? Very important. Number three, when and how do you trade? When do you trade and how do you trade? I'm sure these are the questions that are burning in the hearts of most of us here. We want to be able to understand what it is that's going on, right? We want to be able to understand what exactly is going on. What is it that's been traded? That's what we've been talking about. Different categories of instruments. We're talking about we just mentioned them: currencies, commodities, and so on and so forth. Who else is trading in this market? The reason this is important is you want to know, when it comes to the market, is there somebody who has the ability to control the market? Who am I playing against in the market? Who am I playing against in the market? Are they small players? Are they people with $1,000? Are they people with $5 million? Are they people with billions of dollars? How does that tell on my own trading? How does that affect me positively or negatively? That's what we want to know. Who else is trading in the market? Then when and how to trade. Now, we're going to discuss, we just gave a brief highlight on the instruments that are tradable. Now we're going to attempt to explain them a little more as we progress. Okay. So we'll go back to currencies again. We're trying to explain a little bit so that we can better understand what this means, right? A currency is defined simply as a bill of exchange, acceptable as a legal tender for payment of goods and services. That's what a currency is. Every country has a currency. Okay, and the reason why people deal with currency is because is because of their faith in the government. So this government is a legitimate government. So if this government gives me a bill and tells me that this bill is worth so and so amount, I believe them. Every of us believe them. The reason why the system works is because we all believe that this thing is correct. We all believe that the currency that's been handed to us is actually valuable. So if you're, for example, $100 bill, everybody agrees as to the value of $100 bill. So we now can use that to purchase things, do business, make transactions, make trades, and so on and so forth, because we've all come to agree. If there's a huge segment of the people who say we do not agree in that currency, they will not accept it. And if they don't accept it, then the currency fails. The currency cannot survive when people do not massively adopt it and accept it. So that's for currency. But when it comes to currency trading itself is the exchange of a nation's currency with another nation's currency, thereby making a profit from the continuous change in price. Like I said, what are we doing? We are trying to speculate on price movement. When you pick a currency, we want to speculate on price movement. Is price going to go up? Is price going to come down? That is what we are always trying to determine. Okay. Then these are the major currencies in the world right here. The currency of a country is like the stock of a company. So this is something that helps us understand the nature of currencies. The currency of a country is like the stock of a company. Just like in the case of a company, when a country is doing well economically and politically, now remember, for companies, when you buy stock in a company, you expect it to become more valuable tomorrow. And why is that? Because you're expecting the company to do well economically and politically, do well, not politically, but economically. Okay. Now, if the company doesn't do well economically, you cannot make profit off your investment of that company. If you buy into an asset now and that asset continues to depreciate and do very poorly, it will continue to lose value. It will not appreciate. Okay, so that's how currencies work, and that is how countries work, and that's how currencies work as well. That's how companies work, and that's how countries work as well. All right. So if a country is doing well politically and economically, the currency will become strong. And there are countries in the world we know that the currencies are strong. Now, of course, people who know more will tell you that over time, currency loses its value. Yes, over time, due to inflation, the currency will lose its value. But then when you also measure that currency, if it is a strong currency, in the course of time, when you measure it against other currency, other rival currencies, then you begin to see that that currency is still strong. We have some strong currencies in the world, and those are the currencies we call the major currencies. Call them the major currencies. All right. Now, for the major currencies, the first one is what we call the US dollar. I'm sure a lot of us would expect that the US dollar is the most valuable currency. Okay. Is the most widely used across the world. So we have the US dollar, then we have the Japanese yen, we have the Great Britain pound, we have the Canadian dollar, we have the Australian dollar, we have the euro, which is for the Eurozone, the Euro area. We have NZD, which is for Switzerland, and we have, NZD, which is for New Zealand, and then CHF, which was Switzerland. Okay. So these are what we call the major currencies. And the reason we call them major currencies is because they are pretty stable. They are the currencies of stable economies, political and economic stability. Remember, there can be economic stability if there's no political stability. In a country where bombs are flying across, there's no way the economy can be growing in multiple folds. It can't grow in multiple folds because because there's a political instability, and that doesn't work. So there must be political and economic stability. And when you see a country who has had 20 years of progress with terms of the polity, then you will see that there will be progress everywhere. Okay. Now, these are some of the minor currencies. Minor currencies, in comparison to the majors, they are still minor. They're still minor. So we have the Brazilian real, we have the Polish zloty, we have the Swedish krona, we have the Norwegian krone, right? Now, these are what we call the exotic currencies. Exotic currencies. Now, exotic currency is another category of currencies too. We have the South African rand, we have the Hungarian forint, we have the Mexican peso, we have the Turkish lira, and we have a whole lot more. We have a whole lot more under these currencies. We have a whole lot more too when it comes to minor currencies. We have a whole lot more when it comes to exotic currencies. It's just a cross section, a small fraction. Okay. Now, we come to something very important, and that is currency pairs. Currency pairs. Currencies are traded in pairs. So if you want to trade, you're going to have to pair the currency. You have to take a currency. One currency is always going to be paired with another. And this stems from the fact that everything in our lives is a pair. For you to buy whatever thing, you will need another thing to purchase it. That is a pair. So there are always two sides to every trade. Two sides. There's never a way one person would make a trade and say, I've made a trade. You cannot make a trade except with another party. There are always two parties to a trade, every trade. There's no way to make a trade just by yourself. So in this case, there's no way you can buy euro and say, oh, I want just euro. What are you going to use to acquire the euro? There has to be something for you to acquire the euro with. That's the major currency pairs. Then we have the cross currency pairs, the cross pairs. And something to note about the major currency pairs here is that the major currencies contain the major currency pairs contain the major currencies. Look at these major currencies. Yes, these are the major currencies here. The major currency pairs contain the major currencies and also has the US dollar in it. It has the major currencies and it also has the US dollar in it. So you see Euro USD, there's always dollar there. You have USD JPY, dollar is there. You have GBP USD, dollar is there. Then you have cross pairs. This is another category of pairs. You have cross pairs. Cross pairs. And for cross pairs are mostly made up of two currencies again. So you have Euro GBP, you have GBP JPY, you have AUD CHF. These are cross pairs. And there's more. So progress will show you more. Then we have exotic pairs. Exotic pair is basically the combination of your currency pair and an exotic currency pair. The combination of a regular currency and an exotic currency. So you have USD, you have Euro TRY, that is a major currency and an exotic currency. Major currency, exotic currency. USD, HUF. Major currency, exotic currency. Major currency, exotic currency. Okay. So these are the three categories of pairs. So we'll look at a bit more here. So under the major currency pairs, we have other currencies here. We have the GBP USD, Euro USD, AUD USD, NZD USD, USD CHF, USD CAD, USD JPY. All these are under the major pairs. Now, these major pairs there are advantages why these major pairs are mostly traded by most traders, right? Because one major thing is that they are instruments or assets that have a low transaction cost. A low transaction cost. We won't discuss the transaction cost later, but they are low transaction costs to trading. There's a low transaction cost to trading these instruments. Why? Because there's a whole lot of volume going through them. There's a whole lot of volume. When there's a whole lot of volume going through an asset, the cost of trading that asset diminishes. Then we have major crosses. These are cross pairs. Crosses are also known as cross pairs. We have Euro CHF, Euro GBP, Euro CAD, Euro JPY, GBP JPY, GBP CHF, GBP AUD, GBP CAD, AUD CHF. All these are what we call cross pairs, cross pairs. Then we have another category we call the exotic pairs. The exotic pairs. The exotic pairs contain a regular currency and an exotic currency. A regular currency like the US dollar or a strong currency like the US dollar as against a weak currency or an exotic currency. So an exotic currency here is one of those currencies we mentioned earlier. So you will notice here you have USD Brazilian real, you have USD Hong Kong dollar, you have USD South African rand, you have all across like that. All across like that, right? Now, these are the benefits of trading currencies, and this is what you can call the benefits of trading Forex. Number one, high liquidity. High liquidity. High liquidity. Very, very important. High liquidity. Liquidity is the flow of funds within a system. Liquidity is the flow of funds within the system. That's why many times when someone has a lot of money, they say the person is liquid. Liquidity is the flow of funds within the system. The flow. That's what liquidity is about. Okay, and liquidity, that particular flow is the reason why we are able to make the kind of monies we can make on a weekly or monthly basis, because the market is very volatile, and that volatility shields us traders, right? It helps us also, right? It helps us. Okay, that volatility is the reason why traders can make a lot of money in the market. A lot of money in the market, right? Because there's a lot of funds flowing through the system, flowing through the market. Like I said, it reduces the volatility in the market is what causes cost of trading to decrease. I mentioned that earlier when I was talking about major currency pairs. Then for the market, there is nobody, no singular entity that controls the entire market. And that is a relief, because if you knew it was possible for someone to use their enormous wealth to control the market, it's going to be a challenge. But there's nobody who literally controls this market, because the market is big and it's very deep. This market runs on the $7.5 trillion a day, 24 hours. By the end of today, $7.5 trillion would have changed hands. And that liquidity is what makes it possible to make money in this market. The profit potential. The market is an environment of profit. The exchange market has no restrictions on directional trading, which means that you can either buy or sell and you can make good profit. You can take advantage of whether the market is rising, you can take advantage of whether the market is selling, you can take profit and make money from that. Now we move on to the next category, which is commodities. Okay. By the way, guys, these classes are going to continue. Just keep having them. Then the next category is commodities. Commodities are basic goods that are used in the production process. So many times I usually ask people, when you want to manufacture gold jewelry, what do you use? What is the raw material? The answer is gold. Gold is a commodity for manufacture gold jewelry. Now, if you want to produce all kinds of oil derivatives, PMS, AGO, aviation fuel, and so on and so forth. What do you need? What is the raw material? Crude oil. So you realize that these commodities are mainly, they are mainly extracted from the ground, and they are usually used as inputs in a production process. They are always raw, and they are used as inputs in the production process. Even assets like gold, you don't just dig out gold from the ground and stack it and put it in the shelf. No, there's a refinement process. And then even after it's been refined, it is still used for several other things. But of course, the major quantity of gold in the world are held in reserves by central banks. They're the ones that hold most of the gold, right? So we're talking America, Russia, China. These are the countries that hold the largest quantities of gold. Okay. Now, why that is correct that commodities are inputs in production process, that is for physical commodities. So for the commodities market, there is a physical market and a financial market. There's a physical market and a financial market. The physical market influences the financial market, but the beauty of the financial market is that there is no restrictions. The barrier to entry is very, very low. Think about trying to do a business that has to do with buying and selling gold. You can't even do it within one jurisdiction. You have to travel across the world. You have to go to Dubai, to London, to source London gold, UK gold, to source Dubai gold, to know whether it's 18 karat, 12 karat, whatever karat. Right? So it's very, very important that we understand that there is a physical market and a financial market. So all of that is the physical market. The entry barrier for that is very high, and it's difficult to do that. But for the financial market, which is why you're seeing a lot of attention in financial markets now, for the financial market, all you need to make money in this market is just a phone or any internet-enabled device. Any internet-enabled device is all you need to play in this market. Okay, be it a phone, a tab, a laptop, whatever it is. So now there are three categories of commodities. We have what we call the metals, the energies, and the agri-produce. All the assets you will trade, all the instruments you will trade under commodities fall into these three categories: metals, energy, and agri-produce. Now for metals, there's something unique about metals. Okay, like I said, they are all extracted from the ground, not even with the exception of none. Everyone is extracted from the ground, right? And there is something about commodities. Whenever there is turmoil, there's a challenge in the world, there's some sort of an uncertainty in the world, the beneficiaries are usually commodities. Why? Because people start to pile in their funds into commodities. Why? Because they know that commodities can't be destroyed that easily. Think about what it would take to destroy gold. If you burn it in fire, it will get better. It doesn't go bad. The same thing with several other assets, right here. And then another unique thing is when we talk about flight to safety, you see flight to safety here is what I mentioned already when I said that when investors and traders are perceiving a lot of uncertainty in the market, what they do is they fly to safety. And metals are usually they take cover under the metals, or they take cover with metals. And that's why you see when there is a major event that happens, or a war, a crisis of some sort that happens, what happens is that the commodities, metal commodities appreciate a lot. Metal commodities appreciate a lot. Why? Because they do well, because people have confidence in the fact that they can always come back tomorrow and come for their assets. Someone, I was reading a while ago, someone lost Bitcoin worth over $700 million. Right? Now, Bitcoin is great, but then he mined it years ago when he didn't know what it was. But if it was a physical commodity, he would probably still have it. Right? For BTC is good, that's the nature of it. But what we're just saying is that for the nature of instruments, you don't chase after them. Whenever the economy is not doing well, they benefit because investors run to them. When the market starts doing well again, the financial environment starts doing well again, they move their monies out again from gold and from metals into riskier assets. So metals are known as low risk assets. They are called safe haven. Safe haven. They are very low risk. Then the second category is what we call energies. Energies. These are what powers the world. The physical energies power the world. But then for us as traders, we said before, there's a physical market and there's a financial market. The physical market is all you're seeing here, the drilling, the going to the rig, all of that is physical. Natural gas and export and import and all of that is physical. For us who are playing primarily in the financial market, we don't need to bother about this. As much as we follow what happens within the physical market for the instruments that we're trading, for example, you are trading oil, you want to be able to know what OPEC did last week. You want to be able to know what OPEC did last week and how it will affect markets. If you see that OPEC is having a meeting and they are saying certain things and your finances are a certain way, what you need to do is, and your finances are a certain way, all you need to do is look at what's happening in the physical commodity, but then it's not what determines what you're doing. All you need to do is pick up your phone, check your analyze the market right on your phone or on your internet device, and you're able to enter the market. You're not bothered about, oh, what crude oil is doing, what it's not doing. But then you just follow the news around them. You follow the events, because the physical commodity, as much as we don't deal in the physical commodity, there are events that are connected to the physical commodities that we also be aware of. If you're an oil trader, you should know what OPEC is doing. You don't need to know what you don't need to follow them every day. They don't release news every day. They don't do something. OPEC doesn't do something every day. They do something once in a while, and in the time that they do something, you are aware of what they are doing, and then you're able to take that and then use that idea to trade in the market. Okay, now we're going to get to understanding all of that. Then the third category is what we call agri produce. So these are different kinds of widely utilized commodities. We have corn, we have millet, we have coffee, so many of them. And these are tradable in the financial market as well. Remember, these are not just physical commodities, these are also heavily traded within the financial market, in the financial market as well, right? Now, what are some of the benefits of trading in commodities? Trading commodities, number one, diversification. It's important that you're able to diversify your portfolio. Diversification has always been a very, very good idea when it comes to investing. So diversify. There are different commodities you can trade on. You can trade on different commodities. You can trade on things that are not even commodities at all, like currencies, like stocks, and so on and so forth. There's an opportunity to diversify, because all assets do not give you the same opportunities on a consistent basis. Okay, so if you don't have opportunity in one, you basically want to trade on the other one. But also, as we progress, you understand that there is a key, there is something very important, and that is the idea of focus, where you take an instrument and you focus on it. If you decide tomorrow that if you decide that tomorrow that this is the instrument you want to trade, and there is no trade there, you basically just go and do other things and wait until you have a proper trade, a proper setup for that instrument to trade. Access to information. Commodity trading online is fast becoming more and more popular because traders now have access to well-researched information. You know, when you go to certain places and you go online, you will find that there's a well-researched information that you can take and use to make trading decisions for yourself and be able to make good profit for yourself. Then when it comes to returns, we rehashed that over and over again. Commodity markets are very volatile, and in the market, volatility is something that is good. For someone who doesn't play in the market, the financial market, volatility may connote randomness. But in the market, volatility is not randomness. Volatility is what creates opportunities for us to make money. Okay, there can be huge swings in prices. When price can massively go up or massively come down. Whatever that is, you are able to make money from that. That volatility is good for you as a trader. Smart investors can take advantage of these price swings to make very good profit. So this price swing is what we are banking on. For example, if you buy something and the price doesn't appreciate, you cannot make money. You bought something to sell, you bought a phone, and you're buying it for the purpose of selling it. If the price doesn't change from where you bought it to a higher price, you cannot make profit from that. There's no way to do it. So that's what it is. The volatility is movement in the market. And that is how we are able to capitalize and make money in the market. Okay. So the next category we're going to deal with here is stocks and indices. We mentioned this before. We said stocks is ownership in a company. Indices is basically a basket of stocks, right? Now, when you look at this, you see that there are different examples here. You have examples of indices, examples of stocks. You have, for indices, you have US 30, US 100, UK 50. Like I said, when you see UK 50, that's telling you that that index is based in the UK. And then the 50 is the number of individual stocks that are located within the index itself. Then come to the right-hand side, you see examples of stocks. Examples of stocks, you have Google, you have Facebook, you have Yahoo, you have Apple, you have Nvidia. So many different stocks right now that you can trade and make money from. So basically, that's what stocks and indices are all about. Okay. So we're going to be going into the next thing, which is the major participants in the market. The major participants in the market. On our next class, we're going to breaking this down so you understand who are the participants in the market. I said earlier that it's important to know what is traded in the market, who are those trading in the market, and when and how to trade. Okay, so we're going to be going into these in our next class. So this is what we'll wrap up our class today.